Bandhan Mutual Fund presents MF Corner.
Hey guys, welcome to MF Corner. I'm Pavitra Parekh and today I want to discuss the passive funds and within that actually take a closer look at the exchange traded funds. I have with me Mohit Gang, CEO of Moneyfront. Mohit, thanks for coming down to our studios for this conversation. So, my first question is that Indian investors still have a huge preference, right, for active funds. We like to go into that basket, which is quite contrary to what you see in a lot of other markets. But over the past few years, we have seen the share of passives also pick up quite a bit. So can you just take us through the kind of rise we've seen in index funds, in ETFs? What has that rise been?
Okay, thank you, Pavitra. As always, it's a pleasure being on your show. Look, I think the idea of passives is an idea whose time has come, and I firmly believe in that. I think no one can ignore the power of passives or the power of ETFs globally, the way they are overtaking the active mindset. In India, honestly, we believe more in personal equations, personal relationships. We as Indians always have a soft corner for people-to-people skills and people-to-people conversations, right? And it takes us a little time to get into that automation zone where I think things are auto-managed or things are just managed. But I think globally, that's been the trend, right? And that's where the entire passive story comes into play. ETFs and the passive play in India is played from many fronts. You have ETFs, then you have fund of funds which are based on ETFs, and then you have passive index funds. So these are the three ways, and then you have active funds, obviously, which has been the mainstay of the Indian markets. But if you see the growth of ETFs or the passive funds, and I'm talking the entire basket now, I'm talking the ETF and the passive funds both put together, it's been phenomenal. Majority of the NFOs which come in the country, in fact, which has come last year, were all passive funds, the majority. And to my mind, I think almost 2/3 of the NFOs were passives in nature, right? And the basket is so wide today, it's not just the mainstream indices, it's not just the Nifty or the Sensex indices, you have the market cap indices, which is you have the mid cap indices, the small cap indices, then you have the market structure indices, where you have the quality or the factorial indices, so you have the momentum, the value, the equal weights, the low volatility, the quality indices, and then you have a mix and match of these, right? So there are lot many indices which are now coming up, which is quality plus momentum, quality plus value, and so on and so forth. And you have sectoral. So you have all sectoral and all thematic plays. So the wide scope is huge. The whiteboard is very, very large. Why ETFs are popular globally? I think honestly the whole answer is ETF is an investment vehicle where the tax liability or the cost of an individual is borne only by the individual and not by the entire universe of investors, right? Which is very difficult to understand from a lay investor perspective. Today, when I buy or sell a mutual fund, right, when I sell or buy or do any trade or put in more funds, and the fund house then acts on my money, it is impacting every other investor who's a part of that entire pool, because they are acting, they are selling something to give me money, they are incurring a cost, and this cost is borne by everyone. But when I sell an ETF, my cost is borne only by me, because I am the holder of my own units and it is not impacting the entire pool. So it is more efficient to that sense for people who want to buy and hold from a fairly long-term perspective. ETFs become a great vehicle. And ETFs, obviously, because they are exchange traded, they have certain advantages which are inborn in nature. So to my mind, I think that's been the case, which has led to a lot of rise in ETFs. Plus ETFs can be put to margin. So people who trade a lot in stock markets, they can put it as margin. They can, obviously in India, it is not allowed to short, but in globally you can short it, you can put it to margin, you can lend it, you can borrow against it. So ETFs give you all those flexibilities in a large way.
I think another reason why ETFs are so popular in a lot of economies like the US is because there's a clear tax advantage, right? I mean, in India, that's not the case. So, two questions. SEBI has tried to put out a consultation paper asking for, some suggestions on how they could push the passive. So, what are your suggestions on that? Do you think there should be a tax advantage for ETFs to maybe push that category? And do you think from an Indian investor standpoint, you would recommend someone looking at an ETF over an index fund right now? For the same index?
Got you. Okay, so look, I think, rightly said that in US, the ETFs enjoy a lower tax regime, and that's one of the key reasons why the US market has taken up to ETFs so largely and hugely, right? In India or in any other economy, that's not the case. They are all treated at par. But in India, if you see the FOF structures which are built, has a tax advantage because they are treated like debt funds. And hence, they obviously go through debt taxation, which is now completely at your marginal rate of taxation, which is at putting it at slight disadvantage. So my only request or my only submission has always been that the taxation should be at par. If the underlying is equity, whether it is an FOF structure or it's an ETF or it's an index fund, the taxation should be at par with all other equity funds. And even if it is an international fund, right, even if it is an international ETF or an international FOF, today international FOFs are treated as debt funds. So I think that parity needs to come in, which is to large part answering your question. What was the second part to your question you said?
SEBI has, of course, so this is what you answered on, what you can do to sort of push it as well. Do you think from an Indian investor standpoint, if you are advising someone, would you say that they should go for an ETF over an over an index?
Look, for an Indian investor, if you're a stock market trader, if you are actively into stocks and all, then perhaps maybe you can have ETFs in your portfolio. But if you're not into active stock trading, my submission still will be to go with index funds, right? You can always argue that an ETF might have a slightly lesser tracking error and a little lesser expense ratios. But if you club along with the trading costs, the buy and sell charges and the brokerage fees and everything, it is almost identical to what an index fund is. The good part is if you buy through an index fund, the fund house gives you a backstop, which means you're selling to the fund house, you're buying from the fund house, your liquidity is never a problem. With an index fund, if the volumes are low, the liquidity becomes a challenge. And there are many indices which you see on an ETF format where the liquidity is hardly anything. There are hardly any trades. The AUMs are like 50 crores, 70 crores, 100 crores, and it is very difficult to sell. And sometimes the bid-ask spread on the exchange becomes too wide, right? So it is always good to hold these in an index fund format till such time that the market actually deepens and the volumes are massive, right? Like in an US market, the volumes are massive. There is no challenge in terms of liquidity. But in India, I still think the liquidity is a big issue. Unless you are playing a Nifty index, which is or a Nifty ETF, which is a different case altogether, which is hugely traded by virtue of pension money and PF money and all those things. But any other ETF, it's very difficult to manage liquidity. So my argument will still be, if you're a long-term investor, you should go for an index fund and buy through the fund house route.
Got it, got it. No, that makes complete sense. Now, I want to ask you this question, which I get a lot every time I talk about passives and in the recent past as well. So, someone told me that, for example, if I would have held a passive fund and then HDFC Bank goes and falls like this, then what do I do? But the other way is also true, right? What if you hold a passive fund and none of the actives have taken significant exposure, and then you do get that exposure just on account of something like an Nvidia, right, doing very well. Do you think there are certain categories where it's better to go the passive route? Do you think that's true of large caps? Are there certain pockets where you think that you just might as well get the lower cost and the returns will be pretty similar?
Okay, so it's a very tricky one to answer. Honestly, what is right or what is wrong, only time will tell us. My sense is in next 10 years, as Indian markets evolve and mature further, we will get a very clear answer that what strategy has been working well. However, if you see the last 10-year data, and SEBI paper put it out very rightly in, I think last year or sometime, where they said that majority of the active large cap funds have find it difficult to beat the passive funds. But in last 2 years, if you see the data alone for last 2 years, in fact, all the active funds in the large cap category have beaten the index hands down. But the story is reversed for the mid and small caps.
Yeah, because the index has done so well.
Absolutely, because the broader index and every single stock has done so well. Like, look, last year, honestly, what has happened is out of every 3 stocks in the mid and small cap segment, 1 has doubled, which means the broader index has done exceedingly
Just
well.
hold everything.
Absolutely. Right. So last 2 years, the story is reversed. My sense is, in large caps, unless SEBI increases or widens the definition of large cap per se, today it restricts fund houses to invest in the top 100 companies. If tomorrow it comes and says that the definition of large cap is now not top 100, but let's say by market cap we say 50,000 and 50,000 crore companies and above will qualify as large cap, or the universe increases to let's say 150 companies also, then perhaps active can still find some merit. But within a portfolio of 100 stocks, to find those 70, 80 and just play with the market weights, to my sense, it's a losing battle. And with the cost arbitrage playing hugely in favor of the index funds, there's almost an arbitrage of 70, 80 paisa, if not more, right, which is massive. So my sense is in the large cap category, it has to be index. In this mid and small, investors can do well with a combination, and that combination could be active plus a factor-based passive. I continue to believe that the factor-based passives in mid and small cap will deliver larger alpha to investors going forward than a normal standalone passive fund. A normal standalone passive is also good. I'm not for a minute saying you should not have it, but a combination of factor, normal passive and active is something which I would hugely advocate for a mid and small cap kind of allocation.
Okay, very interesting, and I'm glad you broke it down so someone who is looking to invest can look at these. By the way, there are some NFOs open right now also which are looking at small cap along with smart beta, small cap quality and stuff. So that could be very interesting as well. Mohit, thanks a lot for joining us on this chat as always, and I hope that helps any investor that's looking to get into a passive play, or if you are deciding between the active and passive funds. Thanks for tuning in. There's lots more coming up.
Bandhan Mutual Fund presents MF Corner.